Okay, so it's March 2020. I've watched my entire portfolio move in the same direction at the same time. I mean, stocks were down, real estates were under pressure. At that time, I thought I had built something diversified. It was obvious at that moment that I hadn't. I'm seeing somewhat of a similar pattern play out when different classes that were supposed to move independently, they're just moving together. When I saw everything moving at the same time, it started me thinking about what diversification actually means. And what I found is this. Most high-earning physicians stop at what I consider the most surface level. Like, we own some stocks, we own a little bit of real estate, and we call it a day. But true diversification is something a lot more than that. That's something you've been thinking about, something that's popped up in your mind. Stick around and stay tuned. That's what we're covering today.
Welcome to the Passive Income MD podcast, where we talk about creating your ideal life through multiple streams of income. If you enjoy hearing about this stuff, make sure to hit subscribe. Now let's get on with the show.
Okay, welcome back everyone to the Passive Income MD podcast. I'm Peter Kim, I'm your host. Today we're going to be talking about a topic that sometimes doesn't get talked about enough, especially in physician finance circles. I mean, we talk a lot about building wealth, buying real estate, getting into syndications or different funds. What we talk about less is whether the portfolio we're building actually holds up when conditions shift. Of course, nothing will be perfect. It's impossible to predict everything, but we want to talk about today the different dimensions of diversification. In fact, I'm going to take you through 6 dimensions of diversification that every physician investor should understand. Again, I don't want to make this more complicated than it needs to be. I mean, that's actually the opposite of what I'm trying to do. I'm trying to give you a cleaner way to look at what you've built, find where the real gaps are, and understand everything about that. So let's get into it. In case you don't know Ray Dalio, he is the CEO and founder of one of the largest, most successful hedge funds ever in existence. And he talks about this thing called the holy grail of investing. The idea is that if you hold enough truly uncorrelated assets, you can dramatically reduce your risk for your portfolio without giving up much in returns. In fact, having a nice return. And he puts that number at around 13 to 15 uncorrelated assets. That means they're usually moving in different directions. And when I first heard that, my reaction was somewhere between feeling a little impressed, but then also a little overwhelmed, because most physicians I know, including myself at various points, we have, maybe 2 to 3 different asset classes, 2 to 3 investments that are relatively uncorrelated. Definitely not 15. Here's what I've come to understand. Like, the number itself is not really the point. I think it's the principle is what we need to hone in on. And the honest reality is this: finding 13 to 15 truly uncorrelated assets is hard for most of us. That feels like a full-time job. I mean, we're not running endowments. We don't have access to all these interesting investments. We have clinical schedules. I mean, limited bandwidth, right? And we're trying to build something sustainable alongside a demanding career. Then what do you do with that gap? Trying to get to those uncorrelated assets. I think one way that we can start is to get more intentional within the asset classes that we already have. You stop just assuming that because you have 2 different things, they're actually behaving independently. That's actually what the 6 dimensions are for. So let me go through them one by one. So dimension 1, the asset class. It's important to figure out what's actually inside of it. I mean, this is where everyone starts, I think, and it's the right starting point. But I want to spend more time here than most people do, because even physicians who understand asset class diversification are usually thinking about it too narrowly. I know I've done that. The basic version goes like this: stocks and real estate. They're different asset classes. Just get a little bit of each. The truth is they do respond to some different forces, but having both is definitely better than having only one. And that's true. But that stops short of what I think we really need to think about. What's actually useful? I mean, think about what we mean when we say stocks. And you probably know that owning a single stock is very different from owning a diversified broad index fund. Like, within equities, within those stocks, you can hold domestic, international, large cap, small cap, growth, value, different sectors. There's a whole internal structure to it within this equity asset class. Now, apply that same thinking to real estate. I mean, most people hear real estate and think of it as one thing, whether it's to buy residential, commercial, office, whatever it is. But real estate truly has all these sub-asset classes, just like equities do. And they definitely do not all behave the same way at the same time. There's multifamily, which is apartment buildings, industrial, self-storage, medical office, retail hospitality, mobile home parks. I mean, each of these responds differently to interest rate cycles. They might respond differently to employment trends, demographic shifts, even consumer behavior. I mean, multifamily actually held up pretty well in 2008 because while everything seemed to be crashing around them, people still needed places to live. Retail got hit really hard. Industrial, self-storage, they had long runs over the last 10 years or whatever it might be because of everything that's happened with e-commerce. Medical office is driven by a completely different set of forces than any of those. And I think we all know that inherently.
Hey, what's up, everyone? Just want to ask you a quick question. Are you ready to take your medical career beyond the traditional boundaries of medicine and amplify your impact? Well, I want to tell you about the Leverage and Growth Accelerator community. Just so you know, we created this exclusive community just for physicians like you who want to expand their identities without giving up their doctor identities. It's an add-on, it's not a replacement. When we hosted our first Leverage and Growth Summit, I know many of you have been part of that, we realized that so many doctors were inspired by the what and why of entrepreneurship, but needed help with the how and when. And that's why we created this community called the Leverage and Growth Accelerator to help doctors learn how to start, grow, or scale a thriving business and connect with like-minded individuals who also want to make a positive contribution to the world. Within this community, you can experience a life of greater fulfillment. It's really a powerful antidote to burnout where you can leverage your medical degree for new opportunities and take command of your time and schedule so you can invest in your family's future while enjoying today. In the Leverage and Growth Accelerator, you're going to have access to educational materials, you're going to have insights from expert speakers, small group coaching, and most importantly, you're going to have community support to help you realize your untapped potential. And we're so confident in the transformative power of this members-only community that we're offering the first 30 days for free. If you're interested, I want you to take advantage of this. This window of opportunity is not going to last forever. So go now to lgacommunity.com. Again, that's lgacommunity.com. If you're ready to take your medical career to the next level and make a profound impact in the world and do it together with other like-minded people, it's time to join us. We can't wait to see you inside.
So when you say you own real estate, like what does that actually mean? I mean, if everything you own is multifamily in the same market, you're much more concentrated than the label real estate investor suggests. And a lot of physicians build their portfolio deal by deal, chasing whatever looks good at the time. The result, again, might be concentration inside an asset class they thought was already diversifying them. Again, this dimension, it's not just about owning different asset classes. It's about understanding the internal structure, how each of these has risks, benefits, how they move at different parts of the cycle. It's about understanding each one of those asset classes and making sure you're diversified in that case. All right, now on to dimension two. This one's correlation. And this is the one that March 2020 really made it real for a lot of us. I mean, correlation, just to be clear on it, it measures how much two assets actually move together. Truly diversified assets, they have low correlation. And when one goes down, the other doesn't necessarily follow. Again, does its own thing. The problem is correlation isn't static. Assets that look uncorrelated in normal markets can suddenly move together in a crisis. You might have seen that with Bitcoin or whatever it is, and gold. I mean, liquidity dries up, sentiment shifts, emotions change, and things that were supposed to zig when the market zagged, they just don't. I mean, think about not just what you own, but how those assets behave relative to each other, especially under stress. And that's something I am learning still how to do. I mean, normal market correlation is less useful, I've found, than stress correlation. All right, dimension three, liquidity. Now, this one is underappreciated. I think it's, essentially we all know it's important for physicians. Stocks and real estate, again, they're not necessarily interchangeable when you need quick access to capital. Sometimes you can trade a publicly traded position. You can exit in a day. But with real estate, sometimes you're locked into a 5 to 7 year hold and you can't. You call that illiquidity. It isn't automatically bad. I mean, you're often compensated for it with better returns. I think we all know that if you keep your money in a certain place for for longer, you might have a higher return than if you're able to trade in and out of it. But you should ask yourself, are your assets liquid at the right times for your life? I mean, are you thinking about a career transition, a sabbatical, retirement, or maybe a business investment in the next few years? Those questions should also inform how much of your portfolio is locked up and for how long. So be diversified when it comes to liquidity. Dimension 4, time horizon. Now, related to liquidity a little bit, this is about matching your investments to when you actually need the money to work for you. Now, a 30-year hold in a long-term real estate fund serves a different purpose than capital you're planning to redeploy in 18 months. I mean, both can belong in a well-constructed portfolio, but you can't treat them interchangeably. That's how you end up with a mismatch between your investment structure and your actual life. And that's when you want to ask yourself, what do I need this money to do and when? Then look honestly at whether your investment timelines actually line up with that. Dimension 5, tax treatment. I think this is where the physicians really, really care, and they want to know that this is relevant for them. The after-tax return, that's the real return. That's what ends up in your pocket at the end of the day. A real estate investment that generates passive losses and depreciation looks very different on paper than one that doesn't. Now, if you haven't sat down with a CPA who works with physician investors to look at your portfolio, how it's structured from a tax perspective, I promise you that's worth prioritizing. I mean, a lot of physicians optimize for returns and income before tax, and then under-optimize for what actually stays in their pocket. Dimension 6, geography. And I think this is one of the most overlooked dimensions on this list. A single market concentration, which means just being in one market or a very small market. Again, that's a real risk. That's easy to miss. If you have multiple properties in the same city, maybe it's just where you live, or heavy exposure to one regional economy, you're more correlated than you think. Local job markets might shift, population changes, policy and regulation decisions. All of these things affect all of your properties at once if they're all in the same place. And it goes beyond real estate. If your income, your practice, your home value, and your real estate investments are all tied to the same regional economy, that is true concentration risk. And that doesn't always show up in a typical breakdown of your assets. And so here's what I'd encourage you to do after this episode. Again, wherever you are, wherever you use to track your investments, and if you're not doing that right now, I highly recommend find a place to do that. That could be as simple as Google Sheets or an AI app or whatever it is. It doesn't have to be super formal. And then run it against these 6 dimensions. I say not to grade yourself, but kind of, because you want to see clearly how many asset classes you have. Do they actually hold up when it comes to diversification? What are the internal structure of each one? How do they look? How correlated are they under stress, not just in normal conditions? And do you have the right balance of liquidity for where you are in your life and career? Are your time horizons matched with your actual goals? And how's your portfolio taxed? Is there room to improve that? And lastly, is there geographic concentration? Maybe somewhere there that you haven't looked. Now, most physicians, if they're honest, they're missing coverage in at least 2 or 3 of these, or they're way too heavy in some of those. Again, that's not failure, that's information. And information is what lets you build something more resilient going forward that in tough times will last. Now, stocks plus real estate, it's a place to start, but the physicians who build portfolios that actually hold up over time are the ones who go a layer deeper and then ask, how do these things actually behave together? How do they behave when times are stressed? And where am I exposed in ways that maybe I haven't fully accounted for? I hope that's helpful. As always, we have communities, including Passive Real Estate Academy, that you can join to talk about these things. If we're not open right now, we have a wait list. Please check it out. It's at passiverealestateacademy.com. I appreciate you spending time here. Have an amazing week, everyone, and let's talk again soon.
Enjoy the show? Let me know by dropping a review in the podcast app you're listening to us in. And if you haven't already, make sure to hit subscribe. Join thousands of physicians who are also on this journey to creating their ideal lives through multiple streams of income. Learn more at our website, passiveincomemd.com. Thanks again for allowing me to be a part of your journey. See you next time.